for the long term, how on earth can you invest for the long term? We can assume that it was not the best performers that have gone to their well-earned demise. The fact is that it was the laggards that disappeared. Sometimes their managers moved on. The average portfolio manager, in fact, lasts just 5 years. Sometimes giant financial conglomerates acquired their management companies, and the new owners decided to clean up the product line. These conglomerates, truth told, are in business primarily to earn a return on their capital, not a return on your, the fund investor's, capital. Often, funds with lagging performance saw their investors flee, and they became a drag on their managers' profits. There are lots of reasons that funds disappear, few of them good. A death in the family, funds that falter, and funds that fail. Even funds with solid long-term records go out of business. Often their management companies are acquired by large marketing companies whose ambitious executives simply conclude that, however good the fund's early records, they are not exciting enough to draw huge amounts of capital from new investors. They have simply outlived their usefulness. In other cases, a few years of faltering performance does the job. Sadly, one of the more recent victims of these attitudes was the second oldest fund in the entire mutual fund industry, one that had survived through all of the tempestuous markets of the past 80 years. State Street Investment Trust, 1925 to 2005. Rest in peace. As one of the longest-serving participants in the fund industry, who clearly remembers the classy record of this fund over so many years, I regard the loss of State Street as a death in the family. In any event, 223 of the equity funds of 1970 are gone, mostly the poor performers. Another 60 remain, yet significantly underperform the S&P 500 by more than 1 percentage point per year. Together, then, 283 funds, nearly 80% of the funds among those original 355, have, one way or another, failed to distinguish themselves. Another 48 funds provided returns within 1 percentage point, plus or minus, of the return of the S&P 500. So let's call them market matchers. That leaves just 24 mutual funds, only 1 out of every 14, that outpaced the market by more than 1 percentage point per year. Let's face it, those odds are terrible. What's more, the margin of superiority of 15 of those 24 funds over the S&P 500 was less than 2 percentage points per year, a superiority that may be due as much to luck as to skill. That still leaves us with 9 solid long-term winners. Believe me, it is a tremendous accomplishment to outpace the market by 2 percentage points or more of annual return over 35 years. Make no mistake about that. But here a curious, perhaps almost obvious fact emerges. 6 of those 9 winners achieved their superiority many years ago, often when they were of small size. Years ago, the accomplishments of these 9 successful mutual funds were noticed by investors. Cash poured in, and they got large. But, as Warren Buffett reminds us, a fat wallet is the enemy of superior returns. And so it was. As they grew, the records of 6 of them turned lackluster. One fund, in fact, reached its performance peak way back in 1982, 24 long years ago. On balance, it has lagged ever since. 2 others peaked in 1983. The remaining 3 peaked no more recently than 1993, more than a decade ago. One of these was Peter Lynch's legendary Fidelity Magellan Fund, which has now been struggling for 13 years. That leaves just 3 funds. The fact is that only 1 out of every 120 equity funds that started the race in 1970, only 0.8% of the total, have survived and mounted a record of sustained excellence. I now salute them by name: Davis New York Venture, Fidelity Contra Fund, and Franklin Mutual Shares. Hail to the victors! Significantly, while the portfolio managers for these 3 funds have changed over the years, the frequency of change has been tiny. Succeeding his father, Shelby C. Davis, Chris Davis has managed the Davis Fund since 1991. Since 1996 with Kenneth Feinberg. Will Danoff has been the lead manager of Fidelity Contra Fund ever since 1990, and Michael Price managed Franklin until 1997, followed by a successor who ran the fund until 2005. But before you rush out to invest in these three funds with such truly remarkable long-term records, think about the next 35 years. Think about the odds that they will continue to outperform. Think about their present size. Think about the fact that within that time frame, they are all virtually certain to have at least several new managers. Think, too, about the odds that these funds will even exist 35 years hence. It's a changing and competitive world out there in mutual fund land, and I wish these managers and the shareholders of the funds they run the very best of luck. Conspicuous by its absence from this list of winning funds, of course, is Legg Mason Value Trust, managed since its 1982 inception by legendary investment professional supreme Bill Miller. Since the fund did not begin operations until 1982, it is not on my list, but it provides several lessons about fund performance. Miller, something of a contrarian, is the only manager in the past 4 decades to outperform the S&P 500 for a truly remarkable 15 consecutive years. 1991 to 2005 inclusive. Despite his great ability, the ever-humble Miller would be, I think, the first to agree with Stephen Jay Gould's tenet that long streaks are extraordinary luck imposed on great skill. Just as was the case with Joe DiMaggio's remarkable 56-game hitting streak in baseball, the longer Miller's streak extended, the more attention it got, and the more investor dollars flowed into the fund. But by the autumn of 2006, his streak seemed destined to come to an end, even as did the streak of the Yankee Clipper. The year is not yet out, so no predictions. With the S&P 500 up 7.3% by September, Legg Mason Value was actually down 4.9%, putting something of a dent in the long-term record. Through 2005, the fund's annual rate of return had averaged 15.3% per year, compared to 12.9% for the S&P 500 Index Fund, a nice annual edge of 2.4 percentage points. But by September 2006, the gap had shrunk to 1.8 percentage points, with an annual time-weighted return averaging 14.6%, compared to 12.8% for the index. Unsurprisingly, the major inflows of investor capital did not begin until 1997, the 7th year of the streak. So the dollar-weighted annual return earned by Legg Mason Value shareholders was a sharply lower 10.3% that was far below its time-weighted return and also well below the index return. Is Miller's reversion toward and then below the market mean temporary or enduring? Will the fund be afflicted with the same malaise that afflicted 6 of those 9 long-term winners we just discussed? Or is it merely a brief interval of bad luck? Who can know? Whatever the case, please remember that the odds in favor of owning a consistently successful equity fund were less than 1 out of 100. However one slices and dices the data, there can be no question that funds with long-serving portfolio managers and records of consistent excellence are the exception rather than the rule in the mutual fund industry. The simple fact, using Cervantes' wonderful observation, selecting a mutual fund that will outpace the stock market itself over the long term is like looking for a needle in the haystack. I offer you Bogle's corollary. Don't look for the needle in the haystack, just buy the haystack. The haystack, of course, is the entire stock market portfolio, readily available through a low-cost index fund. The return of such a fund would have roughly matched or exceeded the returns of 346 of the 355 funds that began the 35-year competition that I described at the start of this chapter. And I see no reason that the same fund cannot achieve a roughly commensurate achievement in the years to come. Not through any legerdemain, but merely through the relentless rules of humble arithmetic that you now must know so well. We know that the index fund will deliver substantially all of the stock market's return. But with all the fund manager changes that will inevitably be forthcoming for actively managed funds, with all the funds that will die, with the successful funds drawing capital in amounts that will preclude their future success, and with our inability to be certain how much of a fund's performance is based on luck and how much on skill, there is simply no way to assure success by picking the funds that will best suit us, even by looking to their past performance over the long term. In fund performance, the past is rarely prologue. Don't take my word for it. Need more advice? With his customary wisdom, Paul Samuelson sums up the difficulty of selecting superior managers in this parable. Suppose it was demonstrated that 1 out of 20 alcoholics could learn to become a moderate social drinker. The experienced clinician would answer, even if true, act as if it were false, for you will never identify that 1 in 20, and in the attempt, 5 in 20 will be ruined. Investors should forsake the search for such tiny needles in huge haystacks. In the Wall Street Journal, longtime Getting Going columnist Jonathan Clements asks, "Can you pick the winners?" The answer: even fans of actively managed funds often concede that most other investors would be better off in index funds. But buoyed by abundant self-confidence, these folks aren't about to give up on actively managed funds themselves. A tad delusional? I think so. Picking the best performing funds is like trying to predict the dice before you roll them down the craps table, says an investment advisor in Boca Raton, Florida. I can't do it. The public can't do it. Still, I figure we shouldn't discourage fans of actively managed funds. With all of their buying and selling, active investors ensure the market is reasonably efficient. That makes it possible for the rest of us to do the sensible thing, which is to index. Want to join me in this parasitic behavior? To build a well-diversified portfolio, you might stash 70% of your stock portfolio in a Wilshire 5000 index fund and the remaining 30% in an international index fund. If these comments don't persuade you about the hazards of focusing on past returns of mutual funds, just believe what fund organizations tell you. Every single firm in the fund industry acknowledges my conclusion that past fund performance is of no help in projecting the future returns of mutual funds. In every mutual fund prospectus, in every sales promotional folder, and in every mutual fund advertisement, albeit in print almost too small to read, the following warning appears. Past performance is no guarantee of future results. Believe it. Chapter 9. The Futility of Chasing Short-Term Performance. Fooled by Randomness. The title of a provocative book by Nassim Nicholas Taleb. In selecting mutual funds, however, most fund investors seem to rely not on sustained performance over the long term, but on exciting performance over the short term. Chapter 5 reinforces this point. Studies show that 95% of all investor dollars flow to funds rated 4 or 5 stars by Morningstar, the statistical service most broadly used by investors in evaluating fund returns. These star ratings are based on a composite of a fund's record over the previous 3, 5, and 10-year periods. For younger funds, the ratings may cover as few as 3 years. As a result, the previous 2 years' performance alone accounts for 35% of the rating of a fund with 10 years of history, and 66% for a fund in business for from 3 to 5 years, a heavy bias in favor of recent returns. How successful are fund choices based on the stars awarded on the basis of such short-term achievements? Not very. According to investment analyst Mark Hulbert, a mutual fund portfolio continuously adjusted to hold only Morningstar's 4- and 5-star funds earned an annual return of just 6.9% during 1994 to 2004, nearly 40% below the 11% return on the total U.S. stock market index. In fairness, Morningstar changed the basis for its rating system to reflect performance versus peers with similar objectives rather than funds as a group. The relative performance of the 4- and 5-star funds has improved since then. To make matters worse, according to Holbert, these highly rated funds were assuming even more risk than the market itself. Average monthly volatility in asset value, 16% for the funds compared to 15% for the stock market. The first shall be last. Sadly, the orientation of fund investors toward recent short-term returns works worst in strong bull markets. Consider the example of the top 10 performers among the 851 equity funds in operation during the great new economy market bubble of 1997 to 1999. A wondrous group they were. Focused on internet, telecom, and technology stocks, these funds generated an average return of 55% per year during the upswing, a cumulative return of 279% for the full 3 years. Remarkable. Well, you can guess what came next. The bubble burst, and one by one, just as the good book warned, the first shall be last. Really? Over the next 3 years, 2000 to 2002 inclusive, every one of the original top 10 funds plummeted into the bottom 60, with not a single fund in the original top 10 ranked higher than number 790. Fund number 9 on the upside actually was last, number 851 on the downside. Fund number 1 dropped in rank to number 841. Fund number 2 dropped to number 832, and fund number 3 tumbled to number 845. On average, the one-time 10 top funds in the bull market were outperformed by 95% of their peers in the bear market that followed. For investors who believed that the past would be prologue, it was not a pretty result. Please remember that even a single annual gain of 55% followed by a loss of 34% doesn't leave the investor with a 21% gain. More like 2%. Do the arithmetic. And with 3 years of average annual gains of 55% on the upside and annual losses averaging 34% on the downside, it was much worse. These aggressive new economy funds ended up with a cumulative positive return averaging 13% for the full 6-year period, a far cry from the S&P 500's cumulative gain of 30%. Yet while that return was not particularly satisfactory in terms of the traditional returns reported by the average equity fund, it was hardly a disaster. But for the shareholders of the funds, it was a disaster. By investing after seeing those mouth-watering cumulative returns that had averaged almost 280%, achieved in a soaring bull market, nearly all of the buyers of these funds had missed the upside. Then, not a moment too soon, they caught the full force of the downside. Their funds tumbled by an astonishing average of 70% during the next 3 years. Result, while a net gain of 13% was achieved by the funds themselves, the investors in these funds incurred a loss of 57%. By investing in these once high-flying funds, more than half of the capital investors had placed in these hot funds had gone up in smoke. The message is clear. Avoid performance chasing based on short-term returns, especially during great bull markets. Though the results are hardly as dramatic, the principle of don't chase past performance also holds during more sedate stock markets. In my first book, Bogle on Mutual Funds, 1993, I compared the records of the 20 top-performing mutual funds during each year from 1982 through 1992, with their records in the subsequent year. As it happened, the funds that ranked number 1 in each year averaged a subsequent average ranking of 284 among the list of 681 funds, outpacing 58% of their peers, or barely above average. The highest achievement on the 20-fund list for that period was turned in by the number 1 funds, averaging a rank of 100 in the subsequent years. The clear reversion to the mean suggested by that single test represented powerful evidence that winning performance by a mutual fund is unlikely to be repeated. But of course, there is no reason, except common sense, to assume that the 1982 to 1992 experience would recur. So, just for fun, I repeated the test in 2006, beginning with the top-performing 20 funds in 1995 and the top 20 funds in each of the 9 subsequent years. I then checked the rank of each fund in the following year, just as before. In general, the results were remarkably similar. The average subsequent rank of the top 20 funds in 1995 to 2005 was 619, outpacing 57% of their peers and barely above the average fund among the 1,440 fund total, just like the prior test. In an interesting reversal of fortune, however, the number 1 funds of that era turned out to have not the highest subsequent ranking, but the lowest ranking among the top 20 list. These champions subsequently earned an average ranking of 949 among the 1,440 fund total, outpacing only 34% of their peers. While the first can be first sometimes, the first can be last at other times. A wonderful illustration of the inevitable randomness of fund performance. The message is clear. Reversion to the mean, RTM. In this case, the tendency of funds whose records substantially exceed industry norms to return to average or below is alive and well in the mutual fund industry. As we have seen in stock market blow-offs, the first shall be last. But in more typical environments, reversion to the fund mean, which, as we have seen in earlier chapters, substantially lags the return earned by a stock market index fund, is the rule. So just remember that the stars produced in the mutual fund field are rarely stars. All too often they are comets, lighting up the firmament for a few moments in time and then flaming out, their ashes floating gently to earth. With each passing year, the reality is increasingly clear. Fund returns seem to be random. Yes, there are rare cases where skill seems to be involved, but it would require decades to determine how much of a fund's success can be attributed to luck and how much attributed to skill. And by then, you might ask yourself questions like these. 1. How long will that manager, with that staff, and with that strategy, remain on the job? 2. If the fund's assets are many times larger at the end of the period than at the beginning, will the same results that were attractive in the first place be sustained? In short, selecting mutual funds on the basis of short-term performance is all too likely to be hazardous duty and almost always destined to produce returns that fall far short of those achieved by the stock market itself, so easily achievable through an index fund. Don't take my word for it. Listen to Nassim Nicholas Taleb, author of Fooled by Randomness. Toss a coin? Heads, and the manager will make $10,000 over the year. Tails, and he will lose $10,000. We run the contest for the first year for 10,000 managers. At the end of the year, we expect 5,000 managers to be up $10,000 each, and 5,000 to be down $10,000. Now we run the game a second year. Again, we can expect 2,500 managers to be up 2 years in a row. Another year, 1,250. A fourth one, 625. A fifth, 313. We have now, simply in a fair game, 313 managers who made money for 5 years in a row. And in 10 years, just 10 of the original 10,000 managers. Out of pure luck. A population entirely composed of bad managers will produce a small amount of great track records. The number of managers with great track records in a given market depends far more on the number of people who started in the investment business in place of going to dental school, rather than on their ability to produce profits. That may sound theoretical, so let's get down to brass tacks. Hear Money Magazine's colloquy with Ted Aronson, partner of successful money management firm Aronson Johnson Ortiz. Question: You've said that investing in an actively managed fund, as opposed to a passively run index fund, is an act of faith. What do you mean? Answer: Under normal circumstances, It takes between 20 and 800 years of monitoring performance to statistically prove that a money manager is skillful, not lucky. To be 95% certain that a manager is not just lucky, it can easily take nearly a millennium, which is a lot more than most people have in mind when they say long term. Even to be only 75% sure he's skillful, you generally have to track a manager's performance for between 16 and 115 years. Investors need to know how the money management business really works. It's a stacked deck. The game is unfair. Question: where do you invest? Answer: in Vanguard index funds. I've owned Vanguard Index 500 for 23 years. Once you throw in taxes, it just skewers the argument for active management. Personally, I think indexing wins hands down. After tax, active management just can't win. Finally, Money Magazine columnist and author Jason Zweig sums up performance chasing in a single pungent sentence: buying funds based purely on their past performance is one of the stupidest things an investor can do. Chapter 10. Seeking help in selecting funds? Look before you leap. As we now know from the evidence presented in the 2 previous chapters, selecting winning equity funds over the long term bears all the potential success of looking for a needle in the haystack, and selecting winning funds based on their performance over relatively short-term periods in the past is all too likely to lead, if not to disaster, at least to disappointment. So why not abandon these do-it-yourself approaches and rely on professional advice? Pick a financial consultant, the designation usually used by the stockbrokers of Wall Street and indeed brokers everywhere, or an investment advisor, the designation usually applied to non-brokers who usually, but not always, work on a fee-only rather than commission basis. I'll attempt to answer that question in this chapter, but before I do, I want to note that I'm focusing only on the ability of advisors to help you select equity funds that can produce superior returns for your portfolio. Professional investment advisors provide many other services, including asset allocation, information on tax considerations, advice on saving while you work, and on spending when you retire, and they are always there to consult with you about the financial markets. Advisors can encourage you to prepare for the future and are in a position to help you deal with the many extra investment decisions that have investment implications. That is, when you need to raise cash for a purchase of a home, building a fund for your children's college education, etc. Experienced advisors may also help you to avoid the potholes along the investment highway. Put more grossly, they may help you avoid making such dumb mistakes as chasing past performance or trying to time the market. At their best, these are important services that can enhance the implementation of your investment program. The overwhelming majority of investors rely on brokers or advisors for help in penetrating the dense fog of complexity that, for better or worse, permeates our financial system. If the generally accepted estimate that some 70% of America's 55 million families who invest in mutual funds do so through intermediaries is correct, then only about 15 million families choose the do-it-yourself road. The remaining 40 million families rely on professional helpers. That's the strategy that the Gottrocks family tried, as described in the parable at the beginning of this book, only to find that it resulted in failure. We'll never know exactly how much value is added or subtracted by these helpers. But it's hard for me to imagine that as a group they are other than, well, average. That is, their advice on equity fund selection produces returns for their clients that are probably not measurably different from those of the average fund as described in Chapter 4, some 2.5 percentage points per year behind the stock market itself, as measured by the S&P 500 index. Of course, I'm willing to consider the possibility that the fund selections recommended by advisors are better than average. As I'll explain in the next chapter, if they merely select funds with the lowest all-in costs, hardly rocket science, they'll do better. If they're savvy enough to realize that high turnover funds are highly tax inefficient, they'll pick up important additional cost savings for you in transaction costs and taxes. If they put those two strategies together and emphasize low-cost index funds, as so many advisors do, so much the better for their clients. And if professional investment consultants are wise enough, or lucky enough, to keep their clients from jumping on the latest and hottest bandwagon, for example, the new economy craze of the late 1990s reflected in the mania for funds investing in technology, telecommunications, and internet stocks, their clients could earn returns that easily surpass the disappointing returns achieved by fund investors as a group. Remember the additional shortfall of 2.7 percentage points per year relative to the average equity fund that we estimated in Chapter 5? During 1980 to 2005, the nominal return of fund investors came to just 7.3% per year, despite a wonderful stock market in which a simple S&P 500 index fund earned a return of 12.3%. Alas, from the standpoint of the advisors, there is simply no evidence that the fund selection advice they provide has produced any better returns than those achieved by fund investors on average. In fact, the evidence goes the other way. A recent study by a research team led by two Harvard Business School professors concluded that, during 1996 to 2002 alone, the underperformance of broker channel funds, advisors sold, relative to funds sold through the direct channel, purchased directly by investors, cost investors approximately $9 billion per year. Specifically, the study found that advisor asset allocations were no better, that they chased market trends, and that those they advised paid higher upfront charges. In all, the study concludes that the weighted average return of equity funds held by investors who relied on advisors, excluding all charges paid up front or at the time of redemption, averaged just 2.9% per year. 2.9% per year, compared with the 6.6% earned by investors who take charge of their own affairs. This powerful evidence, however, does not bring the researchers to the clear conclusion that advice in its totality has negative value. We remain, the report states, open to the possibility that substantial intangible benefits exist, and will undertake more research to identify these intangible benefits and explore the elite group of advisors who do improve the welfare of households who trust them. There is other powerful evidence that the use of stockbrokers, as distinct from financial advisors, has a strong negative impact on the returns earned by fund investors. In a study prepared for Fidelity Investments covering the 10-year period 1994 to 2003 inclusive, broker-managed funds had the lowest ratings, relative to their peers, of any group of funds. The other groups included funds operated by privately owned managers, by publicly owned managers, by managers owned by financial conglomerates, and by bank managers. The Merrill Lynch funds, for example, were 18 percentage points below the fund industry average. The Goldman Sachs and Morgan Stanley funds were 9 percentage points below average. And the Wells Fargo and Smith Barney funds were both 8 percentage points behind. It is the job of the brokerage firm and its brokers and financial consultants to sell something every single day. When the firm introduces a new fund, it must be sold to someone. Imagine a day when nobody sold anything and the stock market lay fallow, silent all day long. A Merrill Lynch example illustrates the challenges faced by investors who rely on stockbrokers. In March of 2000, when the bubble created by the internet stock craze was at its peak, Merrill Lynch, the world's largest stock brokerage firm, jumped on the bandwagon with two new funds to sell. Merrill created a pair of new economy funds. One was a Focus 20 fund, based on the then popular theory that if a manager's 100 favorite stocks were good, surely his 20 favorites would be even better. The other was Yes, an Internet Strategies Fund. The public offering of the two funds was an incredible success. Merrill's brokers pulled in $2 billion from their trusting, or was it performance-chasing clients, $0.9 billion in Focus 20, and $1.1 billion in Internet Strategies. The subsequent returns of the funds, however, were an incredible failure. Not surprising. The smartest time to sell a new fund to investors, when it's hot, is often the dumbest time to buy it. Internet Strategies went into the tank almost immediately. Its asset value dropped 61% during the remainder of 2000 and another 62% by October 2001. A total loss of a cool 86%, as most of its investors cashed out their shares at huge losses. Then, with the fund's original $1.1 billion of assets down to just $128 million, Merrill decided to kill Internet Strategies and give it a decent burial, merging it with another Merrill fund. Keeping a record like that alive would have been a continuing embarrassment. For what it's worth, the losses in Focus 20 were less severe. Its asset value declined 28% in the remainder of 2000, another 70% in 2001, and another 39% in 2002, before finally posting positive returns in the 3 years that followed. On balance, its cumulative lifetime return through late 2006 came to minus 79%. Investors have regularly withdrawn their capital, and the fund's assets, which would reach almost $1.5 billion in 2000, currently languish at $82 million, a 95% decline. But unlike its Internet Strategies cousin, Focus 20 soldiers on. The lesson remains. The $2 billion marketing successes of the Merrill Lynch Internet Strategies Fund and Focus 20 Fund were utter failures for their clients, who lost some 80% of their hard-earned savings. The New York Times contest. $50,000 invested in 1993. Capital appreciation of mutual fund portfolios of advisors in 2000, $88,500. In an S&P index fund, $138,750. A more extensive test of the ability of financial advisors to outpace the S&P 500 index was initiated by the New York Times in 1993. The editors asked 5 respected advisors, none were brokers, how they would invest $50,000 for a tax-free retirement account, holding mutual fund shares for an investor who had a time horizon of at least 20 years. The comparative standard would be the returns earned by Vanguard 500 Index Fund. Each quarter, the Times faithfully published the records of the index fund and the advisors, tracking their initial portfolios and the subsequent changes they made. By 2000, 7 years later, the Times reported their accomplishments. The $50,000 hypothetical portfolios run by the advisors had grown, on average, to a value of $138,500 on June 30, 2000. The highest value was $155,100. The lowest, $111,800. While the editors properly acknowledged that not one of these advisors was able to outpace the result of the Vanguard 500 Index Fund, they failed to report its final value based on that initial investment of $50,000. The answer, I thoughtfully provided it to the paper in a subsequent letter to the editor, was $188,750. That is, the average advisor produced a paper profit of $88,500 on his portfolio of recommended funds, about 40% less than the profit of $138,750 on the index fund. All the news that's fit to print? In mid-2000, the Times abruptly terminated the contest without notice. I do not know why, since the original stated intention was to make a 20-year evaluation. But I can guess either that the advisors were too embarrassed to continue to participate in the contest, or that, as the differential in favor of the passively managed index fund grew quarter after quarter, the contest became sort of non-newsworthy, even boring. I also have no idea why the New York Times determined that the remarkable differential in favor of the index fund was not news that's fit to print. Of course, we'll never know what would have happened had the contest continued, but the fact is that the Times terminated it at the moment of triumph for the index fund, and at the very peak of the bull market. Since then, the index fund, like the market itself, of course, has barely held its own. While we don't know whether the advisors would have changed their portfolios, we can calculate how those funds they held in 2000 have since performed. Two advisors did considerably better than the index fund during that subsequent period. One was worse, and one about the same. The results of the fifth advisor can't be measured, for two of the funds in his portfolio no longer exist. Despite this all-too-typical reversion to the mean, the index fund continued its superiority for the full period, with a final value of $181,800 compared to $167,700 for the fund portfolio of the average advisor, surpassing on balance three of the four remaining advisors. So even if we give these advisors the benefit of the doubt in this contest of active fund advisors versus the passive index fund, the index fund wins again. I endorse the idea that for many, indeed most investors, financial advisors may provide valuable service in giving you peace of mind, in helping you establish a sensible fund portfolio that matches your appetite for reward and your tolerance for risk, and in helping you to stay the course in troubled waters. But the evidence I've presented so far strongly confirms my original hypothesis that, vital as those services may be, advisors as a group cannot be credibly relied upon to add value by selecting winning funds for you. Let me add just one final piece of compelling evidence to support that thesis. Mark Holbert, editor of the Holbert Financial Digest, has been monitoring the real-time records of financial advisors who report their recommendations in newsletters subscribed to by investors. He has tracked the performance of these advisors over the past 26 years, and here's what he finds. 1. Most of the several hundred newsletters now being published didn't even exist in 1980. 2. Of the 35 that existed in 1980, only 13 are still in business today. Only 3 outperformed the market over the subsequent 26 years. 3. Of the other 22 advisors, only 2 were ahead of the S&P 500 index when they discontinued publication. 4. An initial $100,000 investment in the S&P 500 index 26 years ago would be worth nearly $2,500,000 today. By way of contrast, a similar investment in the portfolios managed by the advisors tracked by Holbert would be worth about $1,400,000. Holbert's conclusion: you can outperform more than 80% of your fellow investors over the next several decades simply by investing in an index fund and doing nothing else. Deja vu all over again? Perhaps Yogi Berra's famous aphorism is apt here. Consider, if you will, Holbert's finding that only 3 of the 35 original advisory organizations in 1980, 9%, were able to beat the stock market. Then consider the finding in Chapter 8, Don't Look for the Needle, Buy the Haystack, that only 24 of 355 mutual funds in business in 1970, 7%, were able to beat the stock market by 1 percentage point or more per year. Those similar tiny odds in favor of success are sending us the same message. Then consider the return calculated by Holbert on that original $100,000, $2.5 million in the index, compared to just $1.4 million for the portfolio of the average advisor. How similar to the results of the study I prepared for the Vanguard Board of Directors in 1975. My recommendation that we form the world's first index fund was based in part on the fact that $100,000 invested in the average equity fund in 1945 would have grown to $2.5 million in the S&P 500 index versus $1.6 million in the average equity mutual fund. Those similar margins of approximately $1 million in favor of indexing are also sending us the same message. Listen to it. These historic parallels surely reinforce the thesis that index funds endure, while most advisors and funds do not. That index fund returns strongly exceed the returns earned even by those funds and advisors that do survive. That the odds against successful fund selection by advisors are large, and that compounding these rather consistent differentials in rates of annual return mount up to truly staggering differences in wealth accumulation over the long term. If you decide to select an advisor, please consider these findings. Then make sure you are paying a fair fee, which of course results in a deduction from whatever rate of return your fund portfolio earns. Since most investment advisory fees tend to begin in the range of 1% per year, be sure to balance the worth of all the peripheral services that advisors provide against the reduction in your returns that those fees are likely to represent over time. Finally, and this will hardly surprise you, look with particular favor on advisors who recommend stock and bond index funds in their model portfolios. Don't take my word for it. Listen, please, once again to the widely respected investment advisor William Bernstein, who writes in the 4 Pillars of Investment Wisdom as follows: You will want to ensure that your advisor is choosing your investments purely on their investment merit and not on the basis of how the vehicles reward him. The warning signs here are recommendations of load funds, insurance products, limited partnerships, or separate accounts. The best and only way to make sure that you and your advisor are on the same team is to make sure that he is fee only, that is, that he receives no remuneration from any other source besides you. Fee only is not without pitfalls, however. Your advisor's fee should be reasonable. It is simply not worth paying anybody more than 1% to manage your money. Above $1 million, you should be paying no more than 0.75%, and above $5 million, no more than 0.5%. Your advisor should use index or passive stock funds wherever possible. If he tells you that he is able to find managers who can beat the indexes, he is fooling both you and himself. I refer to a commitment to passive indexing as asset class religion. Don't hire anyone without it. Chapter 11. Selecting the lowest cost equity funds. The more the managers take, the less the investors make. What have we learned in the previous 3 chapters? Selecting equity funds based on long-term past performance hasn't been the answer. Selecting funds based on past short-term performance hasn't been the answer either. Even relying on the best-intentioned financial advice seems to work only spasmodically. How can successful fund selection prove so difficult? Because of something that, deep down, we intuitively know. Performance comes and goes. But we also know something else worth knowing. We can be more successful in selecting winning funds by focusing not on the inevitable evanescence of past performance, but by focusing on something that does seem to go on forever, or, more fairly, a factor that usually persists over sustained periods of time. That factor is the costs of owning mutual funds. Costs go on forever. One major cost is the fund's expense ratio, and it tends to change little over time. While some funds scale down their fee rates as assets grow, the reductions are usually sufficiently modest that high-cost funds tend to remain high-cost, that low-cost funds tend to remain low-cost, and the handful of very low-cost funds tends to remain very low-cost, and that average-cost funds, too, tend to persist in that category. Another large cost of equity fund ownership is the sales charge paid on each purchase of shares. It, too, tends to persist. Load funds rarely become no-load funds, and vice versa. I can recall no large fund organization making the immediate conversion from a load to a no-load distribution system since Vanguard took that drastic and unprecedented step more than 30 years ago. Funds portfolio turnover costs also tend to persist. Transactions cost money, and we estimate that turnover costs are roughly 0.5% on each purchase and sale, meaning that a fund with 100% portfolio turnover would cost shareholders about 1% of assets year after year. Similarly, 50% turnover would cost about 0.5%, and 10% turnover would cost about 0.1%, and so on. Rule of thumb: turnover costs equal 1% of the turnover rate. Most comparisons of fund costs rely solely on reported expense ratios, and uniformly find that such ratios correspond inversely with returns. Higher costs are associated with lower returns, not only for equity funds as a group, but in each of the 9 Morningstar style boxes: large, mid, and small cap funds, growth, value, and blended objectives. While few comparisons take into account the additional cost of fund portfolio turnover, a similar relationship exists. Funds in the low turnover quartile consistently outperform those in the high turnover quartile for all equity funds as a group and in all 9 style boxes. When we add that turnover cost to each fund's expense ratio, the relationship is sheer dynamite. Taking into account both costs, we find that the all-in costs range from 0.9% in the lowest cost quartile to 3% in the highest cost quartile. This exercise ignores sales charges and, therefore, overstates the net returns earned by load funds. Costs matter. That 2.1 percentage point difference constitutes a huge portion of the 2.7 point advantage in the returns among the lowest cost funds over the highest cost funds during the past 10 years. Net annual return of low-cost funds, 11.7%. Net annual return of high-cost funds, just 9%. A 30% enhancement in each year's return achieved simply by relying on relative costs as our guide to performance. Please also note that in each of the fund quartiles, when we add the cost to the fund's reported net returns, the gross annual returns earned in each category are virtually identical. They fall into a narrow range, a high of 12.8% for the third quartile and a low of 12% for the fourth quartile. Costs indeed account for the difference. And there is another significant difference. Step by step, as costs increase, so does risk, using as our measure the volatility of monthly returns. Those lowest expense, lowest turnover cost funds assumed fully 34% less risk than their highest cost cousins. When we take that reduction in risk into account, the risk-adjusted annual return for the low-cost quartile comes to 11.9%, fully 47% higher than the 8.1% risk-adjusted return of the high-cost quartile. When we compound those annual returns over time, the cumulative difference reaches staggering proportions. Total compound gain for the period, 207% for the low-cost funds, 118% for the high-cost funds, an enhancement arising almost entirely from the cost differential. In other words, the final value of the low-cost funds more than tripled over the decade, while the value of the high-cost funds barely doubled. Surely, fishing in the low-cost pond should enhance your returns, and by a wide margin at that. Again, yes, costs matter. But if one is seeking the lowest cost funds, why limit the search to actively managed funds? The classic index fund had the lowest costs of all, an expense ratio averaging 0.2% per year during this period. With no measurable turnover costs, its total all-in costs were but 0.2%. The gross return of the 500 index fund was 11.4% per year, the net return 11.2%. Carrying a lower risk than any of the 4 cost quartiles, annual price volatility averaging 15.7%, its risk-adjusted annual return was 11.4%, for a cumulative risk-adjusted gain smack in the middle of the top quartile. The index fund's compound profit of 194% surpassed the 154% compound profit earned by the average fund by about 1/3, all the more impressive since that average is overstated, as always, by the fact that only the funds that were good enough to survive the decade are included in the data. What's more, selecting the index fund eliminated the need for all that looking for those few needles in the haystack, represented by the very few active funds that have performed better than the market haystack itself, in the often vain hope that their winning ways will continue over decades yet to come. If investors could rely on only a single factor to select future superior performers and to avoid future inferior performers, it would be fund costs. The record could hardly be clearer. The more the managers and brokers take, the less the investors make. So why not own an index fund with no manager and no management fee, and with virtually no trading of stocks through those helpers that we mentioned in Chapter 1? Why not indeed? The next chapter will explain this idea further. Don't take my word for it. Beginning as far back as 1995, Tyler Matheson, then executive editor of Money, conceded the point. For nearly 2 decades, John Bogle, the tart-tongued chairman of the Vanguard Group, has preached the virtues of index funds, those boring portfolios that aim to match the performance of a market barometer. And for much of that time, millions of fund investors, not to mention dozens of financial journalists, including this one, basically ignored him. Sure, we recognize the intrinsic merits of index funds, such as low annual expenses, and because the funds keep turnover to a minimum, tiny transaction costs. Moreover, because index fund managers convert paper profits into realized gains less frequently than do the skippers of actively managed funds, shareholders pay less tax each year to Uncle Sam. To be sure, those 3 advantages form a trio as impressive as Domingo, Pavarotti, and Carreras. Well, Jack, we were wrong. You win. Settling for average is good enough, at least for a substantial portion of most investors' stock and bond portfolios. In fact, more often than not, aiming for benchmark matching returns through index funds assures shareholders of a better-than-average chance of outperforming the typical managed stock or bond portfolio. It's the paradox of fund investing today. Gunning for average is your best shot at finishing above average. We've come around to agreeing with the sometimes prickly, always provocative fund exec known to admirers and detractors alike as St. Jack. Indexing should form the core of most investors' fund portfolios. So, here's to you, Jack. You have a right to call it, as you recently did in a booklet you wrote, The Triumph of Indexing. Thanks, Tyler. Chapter 12. Selecting Index Funds that Own the Entire Stock Market. The Majesty of Simplicity. If low costs are good, and I don't think a single analyst, academic, or industry expert would disagree that low costs are good, why wouldn't it be logical to focus on the lowest cost funds of all, index funds that own the entire stock market? Today, several index funds carry expense ratios of as low as 0.1% or even less, and incur turnover costs that turn out to be zero. All-in costs of just 10 basis points per year, 80% lower even than the 90 basis points for the low-cost quartile of funds described in the previous chapter. And of course, it works. Witness the real-world superiority of the S&P 500 index fund over the average equity fund over the past 25 years and over the previous decade that you've seen in earlier chapters. The case for the success of indexing in the past is compelling and unarguable. And with the outlook for subdued returns on stocks during the decade ahead, let me conclude my anecdotal stroll through the relentless rules of humble arithmetic with a final statistical example that suggests what the future may hold. We can in fact use statistics designed to project the odds that a passively managed index fund will outpace an actively managed equity fund over various time periods. The complex exercise is called Monte Carlo simulation. Footnote: basically, a Monte Carlo simulation takes all of the monthly returns earned by stocks over a long period, even a full century, scrambles them randomly, and then computes the annual rates of return generated by each of the thousands of hypothetical portfolios. What it does is make a few simple assumptions about the volatility of equity fund returns and the extent to which they vary from the returns earned in the stock market, as well as an assumption about the all-in costs of equity investing. The particular example I now present assumes that index fund costs will run to 0.25% per year, and that the costs of active management will run to 2% per year. Note that this is a larger cost than available through the lowest cost index funds, and a much smaller cost than is typified equity mutual funds. As a result, we've given actively managed funds the benefit of a very large doubt. Result: over 1 year, about 29% active managers on average would be expected to outpace the index. Over 5 years, about 15% would be expected to win. Over 10 years, 9%. Over 25 years, 5%. And over 50 years, just 2% of active managers would be expected to win. How will the future actually play out? Of course, we can't be sure. But we know what the past 25 years looked like, and we know that over the past 35 years, only 9 of the 355 funds in business at the outset were able to outperform the stock market index by more than 2% per year. What's more, even the majority of these winners lost their early edge a decade or more ago. So it looks like our statistical odds are in the right ballpark. Thus, it seems clear that stock index funds deserve an important place in your portfolio, even as they constitute the overriding portion of my own. Whatever the case, in the era of subdued returns that most likely lies in prospect, fund costs will become more important than ever. Even more so when we move from the illusion that mutual funds as a group can capture whatever returns our financial markets provide to the even greater illusion that most mutual fund investors can capture even those depleted returns in their own fund portfolios. So what the index fund has going for it is, as I have often said, the magic of simplicity in an empire of parsimony. So let me reiterate. Don't ever forget all of those pesky costs. Fund expense ratios, sales charges, and turnover costs, tax costs, and the most subtle cost of all, the cost of living. The rising cost of living, which we describe as inflation, is virtually guaranteed to substantially erode the spending power of our investments over time. Also, don't ever forget that only in the rarest cases do fund investors succeed in capturing the returns that the funds themselves report. My conclusions about the market returns we can expect in the years ahead, as well as my conclusions about the share of those returns that funds will capture, and the share of those returns that we investors will actually enjoy, have one thing in common. They rely not on opinion, but largely on mathematical facts, the relentless rules of humble arithmetic, the very same rules that make selecting winning funds rather like looking for a needle in a haystack. Only at your peril should you ignore these rules. If, as I said at the outset, the road to investment success is hazardous, filled with dangerous turns and giant potholes, never forget that simple arithmetic can enable you to moderate those turns and avoid those potholes. So do your best to diversify to the nth degree, minimize your investment expenses, and focus your own emotions where they cannot wreak the kind of havoc that they create in most investment programs. Rely on your own common sense. Emphasize all stock market index funds. Carefully consider your risk tolerance and the portion of your investments you allocate to equities. Then, stay the course. I should add, importantly, that all index funds are not created equal. While their index-based portfolios are, of course, substantially identical, their costs are anything but identical. Some have minuscule expense ratios. Others have expense ratios that surpass the bounds of reason. Some are no-load funds. Nearly a third, as it turns out, have substantial front-end loads, often with an option to pay those loads over a period of usually 5 years. Others entail the payment of standard brokerage commission. Today, there are some 115 index mutual funds designed to track the S&P 500 index. Astonishingly, more than half of them carry an initial sales load, albeit often concealed by offering Class B shares with no front-end load but an extra heavy annual fee used to pay the broker. The wise investor will be sure to select only those index funds that are available without sales loads, and those operating with the very lowest costs. These costs, no surprise here, are directly related to the net returns delivered to the shareholders of these funds. In the past, some 500 index-based funds may have earned small increases in return or been penalized by small reductions based on their manager's ability or inability to employ strategies that allow small short-term departures from the exact weightings of the stocks in the index. I assume, however, that these variations will be lower in the future and have therefore ignored them as an element in the cost-value equation. Funds tracking a particular index are, or should be, commodities in terms of their portfolios and the returns they provide. So variations in costs make the difference. While cost differentials may look trivial when expressed on an annual basis, compounded over the years, they make the difference between investment success and failure. Profit earned in Index 500 Fund A, $99,100. In Index Fund B, $122,700. All index funds are not created equal. Let's go back to January 1984, for example, when the second index fund was formed, Wells Fargo Equity Index Fund, and compare its subsequent return with that of the original Vanguard Index Fund over the same period. Both funds selected the S&P 500 index as their benchmark. The Vanguard Index 500 carried no initial sales commission and operated with an expense ratio averaging 0.28% annually. By 2005, the ratio had decreased to 0.18% and to 0.09% for longer-term investors and those who had $100,000 or more invested in the fund. The Wells Fargo Fund, on the other hand, carried an initial sales charge of 5.75%, and its expense ratio averaged 0.8% per year, 0.64% in 2005. These seemingly small differences added up to a 23% enhancement in value for the Vanguard Fund. An original investment of $10,000 in each produced a profit of $122,700 for the Vanguard 500 Index Fund, compared to $99,100 for the Wells Fargo Equity Index Fund. All index funds are not created equal. Intelligent investors will select the lowest cost index funds that are available from reputable fund organizations. Your fund should be your cash cow, not the manager's. Some years ago, a Wells Fargo representative was asked how the firm could justify such high charges. The answer? You don't understand. It's our cash cow. That is, it generates lots of profits to the manager. By carefully selecting the lowest cost index funds for your portfolio, you can be sure that the fund is not the manager's cash cow, but your own. Given my preference for the all-market index fund, I almost hesitate to tell you that, since that lonely first S&P index was formed in 1975, a staggering total of another 578 more index funds are now in operation. So investors now face a mind-boggling set of confusing choices: large cap, mid cap, small cap, industry sectors, international, single country, and so on. To make it even more confusing, indexing works like a charm in every one of these areas. An index fund is inevitably destined to surpass the returns earned by the other investors in the market segment tracked by its index. Even though we never have complete information about the precise returns earned by investors as a group in each segment, given the relentless rules of humble arithmetic, it must work that way. Standard & Poor's Corporation now compares index returns with actual returns achieved by active managers in a whole variety of U.S. market segments, and the results are unmistakable. Over the past 5 years alone, the S&P 500 index has outpaced 67% of large-cap general equity funds, while the S&P Mid-Cap 400 index has outperformed 84% of mid-cap funds, and the S&P Small-Cap 600 index has outperformed 79% of all small-cap funds. Remarkable but unsurprising. While these comparisons, sorted by number of funds rather than by fund assets, have the flaws noted earlier, the message could hardly be clearer. Indexing is the winning strategy. It's worth noting that Standard & Poor's attempts to take survivor bias into account in its calculations. Interestingly, during the past 5 years alone, an astonishing 28% of all general equity funds have gone out of business. That's one more warning about relying on actively managed mutual funds as long-term investments. While it is alleged that indexing doesn't work in less efficient markets, that is, outside of the S&P 500, the impressive performance of the small and mid-cap index suggests that it works perfectly well, as it must. For whether markets are efficient or inefficient, as a group, all investors in that segment earn the return of that segment. Yes, in markets that are inefficient, the most successful managers may achieve unusually large returns. But never forget that as a group, all investors in any discrete segment of the stock market must be, and are, average. For each big success, there must also be a big failure. But after all those deductions of even larger management fees and the damaging impact of the even larger turnover costs that funds incur in less efficient markets, the aggregate lag widens. So even in individual market segments, index funds, with their tiny costs, win again. International funds are also subject to the same allegations that it is easier for managers to win in supposedly less efficient markets, but also to no avail. S&P reports that the international index, world markets less U.S. stocks, outpaced 80% of actively managed international equity funds over the past 5 years. Similarly, the S&P Emerging Markets Index outpaced 88% of emerging market funds. I'm not sure what additional data are required to make the case for indexing. But while investing in particular market sectors is done most efficiently through index funds, betting on the winning sectors is exactly that, betting. And emotions, once again, are almost certain to have a powerful negative impact on the returns the investors achieve. Whatever returns each sector itself may earn, the investors in those very sectors will likely, if not certainly, fall well behind them. For there is abundant evidence that the most popular sector funds of the day are those that have recently enjoyed the most spectacular recent performance, and that such after-the-fact popularity is a recipe for unsuccessful investing. For example, when Vanguard created the industry's first growth index and value index funds in 1992, the former was designed for younger investors focused on wealth accumulation, seeking tax efficiency, and willing to assume larger risks. The latter was designed for older investors, focused on wealth preservation, seeking higher income, and happy to reduce their risks. Alas, while the original idea was strong, the ensuing reality was weak. What followed their introduction was as crystal clear an example of classic performance chasing as one could imagine. During the 1993 to 1997 period, the stock market was relatively placid, and value stocks and growth stocks delivered similar returns. Then, in the new economy bubble, growth stocks took off, earning a cumulative return by 2000 that left value stocks in the dust. 1992 to March 2000, growth index total return, 364%. Value index total return, 229%. Après-moi le déluge. Reversion to the mean took hold, and growth stocks plummeted through 2002. Investor interest in the two fund styles was well balanced during the early years. But in the bubble that followed, investors poured $11 billion into the soaring growth index fund, nearly 4 times the $3 billion invested in the sedate value index fund. Then, in the aftermath, investors switched their loyalty, with net redemptions of $850 million in the growth fund during 2001 to 2006, and net purchases approaching $2 billion in the value fund. Since 1993, the two funds have achieved substantial positive returns on a standard time-weighted basis, 9.1% per year for growth and 11.2% for value. With their counterproductive timing and selection, however, investors in these index funds have not come even close to matching those returns. The average dollar-weighted return of investors in the growth index fund was a pathetic 0.9% per year. While investors in the value index fund did better, their return of 7.6% still lagged the return of the value index itself by 3.6 percentage points per year. Since 1993, the cumulative return of the growth index has been 224%, versus 320% for the value index, based on the traditional calculation of fund performance. The growth index fund investor, meanwhile, earned but 13%, and the value index fund investor earned about 170%. Despite my best intentions when they were formed, Vanguard's growth and value index funds proved to be a paradigm for the ways that investors fool themselves, relinquishing perfectly acceptable long-term returns in their search to find the holy grail of extra returns in the short run. So look before you leap in trying to pick which market sector to bet on. It's not as exciting, but owning the classic stock market index fund is the ultimate strategy. It holds the mathematical certainty that marks it as the gold standard in investing, and the alchemists of active management cannot turn their own lead or copper or iron into gold. Just avoid complexity, rely on simplicity, take costs out of the equation, and trust the arithmetic. Don't take my word for it. If you think that my calculation of the odds that only 2% of all equity mutual portfolios will outperform the stock market over 50 years are too pessimistic, consider the odds calculated by Michael J. Mauboussin, Chief Market Strategist at Legg Mason, Adjunct Professor at Columbia Business School, and author of the best-selling More Than You Know. While my 2% estimate would mean that one portfolio in 50 would outperform the stock market, Mauboussin calculates the odds at 1 in 223,000. Either way, the odds of outpacing an all-market index fund are, well, terrible. Now listen to Warren Buffett's widely esteemed partner, Charlie Munger, who eloquently states the case for shunning the foolish complexity of investing and opting for simplicity. At large charitable foundations in recent years, there has been a drift toward more complexity. Some foundations have tried to become much better versions of Bernie Kornfeld's Fund of Funds. In some funds, there are not few but many investment counselors, chosen by an additional layer of consultants who are hired to decide which investment counselors are best, help in allocating funds to various categories, ensure that claimed investment styles are scrupulously followed, plus a third layer of the security analysts employed by investment banks. There is one thing sure about all this complexity: the total cost of all the investment management, plus the frictional costs of fairly often getting in and out of many large investment positions, can easily reach 3% of foundation net worth per annum. All the equity investors in total will surely bear a performance disadvantage per annum equal to the total croupier's costs that they have jointly elected to bear. And it is unescapable that exactly half of the investors will get a result below the median result after the croupier's take, a median result that may well be somewhere between unexciting and lousy. The wiser choice is to dispense with the consultants and reduce the investment turnover by changing to indexed investment in equities. Chapter 13. Bond Funds and Money Market Funds. The relentless rules repeat even more powerfully. So far, all of our discussion about the index fund and its handmaiden, low investment costs, has related to the stock market and to equity mutual funds. But the relentless rules of humble arithmetic with which I've regaled you also apply, arguably even more forcefully, to bond funds and money market funds. Perhaps it's obvious why this is so. While a seemingly infinite number of factors influence the stock market and each individual stock that is traded there, a single factor influences the bond market and the money market, and for that matter, each individual fixed income security, far more than any other: the prevailing level of interest rates. Managers of fixed income funds can't do much, if anything, to influence rates. If they don't like the rates established in that market, calling the Treasury Department or the Federal Reserve, or otherwise trying to change the supply and demand equation, is unlikely to bear fruit. So let's be clear. In the long run, virtually 100% of the return on any bond fund or money market fund is accounted for by the net interest income it generates for its shareholders. The only way for a manager to add an increment to that return is to make interest rate bets. For example, selling bonds when the market expects rates to go up and prices down, and then buying bonds when the reverse is expected to happen. If you think that picking stocks and timing their purchase is hard, just imagine how hard it is to execute these same strategies successfully in the incredibly efficient precincts of the bond market. Thus, managers of fixed income funds will almost inevitably deliver an investment return that parallels the baseline constituted by the interest rate environment. Yes, a few managers might do better, even do better for a long time, by being extra smart or extra lucky, or by taking extra risk. Yet even the best bond and money market managers can add only a few fractions of 1% per year to your long-term returns, albeit only by risking a comparable shortfall. What's more, even if these margins are achieved, they rarely overcome the fees, sales loads, and expenses involved in acquiring their services. While these costs make the task of adding returns far more difficult, overly confident bond fund managers may be tempted to take just a little extra risk by extending maturities of the bonds in the portfolio. Long-dated bonds, say 30 years, are much more volatile than short-term bonds, say 2 years, but usually provide higher yields. They are also tempted to reduce the investment quality of the portfolio, holding less in U.S. Treasury bonds, rated AAA, or in investment-grade corporate bonds, rated BBB or better, and holding more in below investment-grade bonds, BB or lower, or even some junk bonds, rated below CC, or even unrated. Since stocks represent the residual ownership or equity of corporations, we don't usually associate the word safety with them. Unlike bonds, stocks can't default. Bonds, on the other hand, represent debt. If the payments of interest that corporations and governments promise to make every 6 months are threatened, their ratings will be downgraded and their market values reduced. And if they finally fail to make the promised payments, they enter bankruptcy proceedings. Where bonds are concerned, Brandeis's warning becomes particularly meaningful. Remember, O stranger, arithmetic is the first of the sciences and the mother of safety. There are too many types of bond funds to try your patience by examining all of them. So let's examine the 3 basic maturity levels that have become the industry standard, one in each of the 3 major bond segments: taxable, corporate and government bonds, tax-exempt municipal bonds, and U.S. Treasury bonds. We'll begin with intermediate-term taxable bond funds, then turn to long-term tax-exempt bond funds, and then evaluate funds investing in short-term U.S. Treasury notes. As you'll see, the low-cost intermediate-term bond index fund is a truly superior performer. This finding should no longer surprise you. Footnote: I apologize, sort of, for using Vanguard funds for the examples of the market indexes. But there are few other bond funds in these categories using index or index-like strategies, and literally none with lower costs. With a 10-year return averaging 6.8% annually, it comes within a whisper of outpacing the cost-adjusted return of the comparable Lehman 5 to 10-year government corporate bond index. What is more, the index fund's annual return of 6.8% was almost 25% higher than the 5.5% return of its average peer. While the actively managed bond funds as a group earned a lower gross return than either the index fund or the index, relative cost proved to be the principal differentiator in net return. As a group, the portfolios of the actively managed bond funds include about 25% corporate and 75% U.S. government bonds, largely bonds of government agencies, while the bond index and the bond index fund include about 50% in corporates and 50% in governments. While the bond index fund carried slightly more volatility risk, with an annualized standard deviation of 5% versus 3.7% for the active managers, both figures represent an extremely low risk level. And so the message echoes. In intermediate-term taxable bond funds, in terms of maximizing your return and minimizing your risk, the low-cost index fund is truly a superior performer. The Vanguard Intermediate Term Bond Index Fund, for example, has an expense ratio of 0.18%, less than 1/5 of the 1% expense ratio of its average peer. In addition, its return benefits from the absence of sales loads. Always avoid bond funds with sales loads. A typical 5% load, for example, would obliterate your entire yield for the first year. With a cumulative final value of an initial investment of $10,000 growing to $19,289 in the index fund, versus just $17,081 for its average rival, the index strategy is a winning strategy, outpacing an amazing 550 of its 570 peers over the past decade. In long-term tax-exempt bond funds, once again, indexing wins. Now let's consider long-term maturities and turn our attention to tax-exempt municipal bond funds. Because of complexities in the construction of municipal bond indexes, there are no pure index funds in this category. But the results of the major index in the field, the Lehman Brothers Tax-Exempt 10-Year Maturity Index, confirm the power of indexing in surpassing the returns provided by the average active bond manager. Since the index itself provided a gross return of 5.93%, a comparable index fund, after assumed costs of 0.2%, would have provided a 5.73% net annual return. By way of comparison, the Vanguard Long-Term Tax-Exempt Bond Fund, whose expense ratio of 0.15% is actually slightly below these assumed costs for the index fund, provided a net return of 5.85%, a bit higher even than the assumed return of the bond index fund. Like the index fund, this bond fund is broadly diversified, holds a high-quality portfolio, 87% rated A or better, even higher than its actively managed peers, and minimizes turnover. Once again, low costs lead to higher returns. The 5.73% annual return of the hypothetical municipal bond index fund was roughly 15% more than the 5% earned by the average long-term municipal fund, even though the actively managed funds were assuming higher risks, 15% in lower-rated bonds versus 4% for the index and 13% for the Vanguard fund. Over the past decade, $10,000 initially invested in the Vanguard Long-Term Municipal Bond Fund grew to $17,657 versus $16,306 for its average rival. Again, with low costs, broad diversification, and no serious attempt to outguess the market in long-term tax-exempt bond funds, once again, indexing wins. Its close proxy, the Vanguard Long-Term Municipal Bond Fund, ranks first among its 194 peers. In short-term Treasury funds, the lowest cost option wins again. Our sweep of the bond fund arena concludes with an examination of short-term funds investing in U.S. Treasury obligations. There are few surprises here. The net return earned by the index itself, 5.06% per year, adjusted for an assumed expense ratio of 0.2%, outpaces the average fund. Again, while the Vanguard Short-Term Government Bond Fund is not, technically speaking, an index fund as such, it tracks the index return with remarkable precision, turning in a net average annual return of 5.06% over the past decade. The lowest cost options win again, outpacing 97 of the 122 short-term government funds. Treasuries being treasuries, investment quality is virtually uniform. Both the Vanguard Index Fund and the index itself hold 100% of their portfolios in short-term U.S. Treasury notes, and the active funds hold 99%. With its towering 0.92% average expense ratio, the average bond fund has a lot to overcome. It doesn't succeed, it really can't succeed, in overcoming that handicap. What's more, the index and the Vanguard fund displayed slightly less volatility than their active peers. Again, many of these funds carry sales charges averaging 3%, which are incorporated into the average return. The tracking of its benchmark, its quality parity, and its extremely low expenses clearly mark the Vanguard Short-Term Treasury Bond Fund as the functional equivalent of the Lehman 1 to 5 year government bond index. While there are no bond funds that track this index, the Vanguard Fund is the virtual equivalent of an index fund. Both provided cumulative gains on an initial investment of $10,000 of $16,382, compared to $15,588 for the average short-term Treasury fund. In money market funds, surprise, low cost wins yet again. Money market funds can be thought of as very short-term bond funds with uniformly high credit quality. Federal regulations limit money market funds to high-grade commercial and bank paper, and as a practical matter, limit maturities to the very short term, about 60 days, in order to maintain a stable asset value of $1 per share. Unlike bank savings accounts, money market funds are not guaranteed by the Federal Deposit Insurance Corporation. As a result, money market funds hold portfolios with generally similar quality, though there is often a bit of stretching for yield going on, and very short maturity, usually averaging about 40 days. As a result, they tend to earn substantially identical gross yields on their portfolios. With their short maturities, extremely high credit quality, and broadly diversified portfolios, money market funds too essentially become commodities. That is, when all else is equal, as it is here, what determines relative performance is relative cost. So, just as in stock index funds and in bond index funds, cost tells virtually the entire story in money market funds. Indeed, if we rank the records of the 190 money market funds in terms of the returns they have delivered to investors over the past 10 years, highest first, and then compare their expense ratio, lowest first, the relationship is almost perfect. Vanguard Prime Money Market Fund, close cousin to our hypothetical index fund, carries the day, producing a net annual return of 3.77% for the past decade, some 15% above the return on the average money market fund. Cumulatively, a $10,000 initial investment in the Vanguard Prime Money Market Fund grew to $14,478 over the past decade, versus $13,785 for its average peer. Among 190 comparable funds, it ranked number 7. Remarkably, money market funds in the high-cost quartile earned a gross return of 4.1%, about equal to the average, of course. But with a shocking annual expense ratio of 1.39%, these high-cost funds delivered a net return of just 2.71% to their owners. Why would investors ever pay more than a 0.5% annual cost for a money market fund? The answer is beyond me. They should probably have their heads examined. How the supposedly independent directors of these 45 money funds, with expense ratios at or above the 1% level, could vote to approve such fees is an even bigger question. Their job is to represent the interest of the fund shareholders, and they have failed. But intelligent investors don't need to fail. If you avoid these high-cost money market funds in favor of low-cost funds, success will inevitably follow. I realize full well that investors are far more focused on equity funds and the stock market than on fixed income funds. Nonetheless, smart investors will save themselves lots of money and substantially improve their returns if they apply the principles of broad diversification, low cost, no load, minimal turnover, and long-term investing, the very characteristics that enable index funds to guarantee you your fair share of the returns in the bond and money markets, even as they do in all financial markets. Don't take my word for it. While not a lot has been written about the remarkable and remarkably obvious value of index funds that invest in bonds, the convictions that I express in this chapter have been strongly reinforced by Walter R. Good, CFA, and Roy W. Hermanson, CFA, in Index Your Way to Investment Success. Comparison of expenses, transaction costs, and, where applicable, sales loads identify the cost advantage for bond index funds. For the purposes of projecting returns, Let's assume that the actively managed fund and the benchmark index fund each hold bonds that, overall, yield the same 7% annual rate of return. For the actively managed load funds, the index fund advantage amounts to 1.2 percentage points per year. The data provide a sobering glimpse of the challenge encountered by the active bond fund manager and suggest how much additional return active management may have to add, on average, over an extended period, just to break even. Near-index bond mutual funds provide an alternative to indexing the bond market. While the funds do not completely conform to the index fund model, they share key characteristics: very high degree of diversification in the specified market segment, very low expense ratio, very low transaction costs, and absence of sales loads. Once again, further confirmation comes from across the pond. England's Timothy Hale, author of Smarter Indexing, Simpler Decisions for Better Results, writes, "You should not overlook the efficacy of index investing for bonds, which up to now has been whispered rather than shouted from the rooftops. The evidence is compelling and comes down firmly in favor of investing in index funds. Over the 10-year period, 1988 to 1998, U.S. bond index funds returned 8.9% a year against 8.2% for actively managed bond funds, with index funds beating 85% of all active funds. This differential is largely due to fees." Chapter 14. Creating Indexes That Beat the Market. The New Paradigm? Since the inception of the first index mutual fund in 1975, indexing, investing in passively managed, broadly diversified, low-cost stock and bond index funds, has proved to be both a remarkable artistic success and a remarkable commercial success. In previous chapters, we've described the artistic success of index funds in providing returns to investors that have vastly surpassed the returns achieved by investors in actively managed mutual funds. Given that record, the commercial success of indexing is hardly surprising. Today, most indexed assets are concentrated in classic index funds, representing the broad U.S. stock market, the S&P 500 or the Dow Jones Wilshire 5000, the broad international stock market, the Morgan Stanley EAFE, Europe, Australia, and Far East Index, the broad international stock market, and the broad U.S. bond market. But a whole variety of market sector index funds has also sprung up, based on indexes of growth stocks, value stocks, mid and small cap stocks, and a variety of other discrete market segments. Any market segment that can be accurately defined and measured and made available to investors as a group can be easily indexed. Assets of the traditional classic stock index funds have grown from $16 million in 1976 to $445 million in 1986, to $68 billion in 1996, to $369 billion in 2006. 7% of the assets of all equity mutual funds. Assets of bond index funds have also soared, from $132 million in 1986 to $6 billion in 1996, to $62 billion in 2006, 7% of the assets of all corporate and treasury bond funds. Indexing has become a competitive field. Managers of the classic index funds are engaged in a fiercely competitive price war, cutting their expense ratios to draw the assets of investors who are smart enough to realize the price is the difference. This trend is great for index fund investors, but it slashes profits to index fund managers and discourages entrepreneurs who start new fund ventures in the hopes of enriching themselves by building fund empires. So how can promoters take advantage of the proven attributes that underlie the success of the index fund? A tracking portfolio that affords broad diversification, is passively managed, and offers lower costs than actively managed mutual funds. Why, create new indexes, and then claim that they will consistently outpace the broad market indexes that up until now have pretty much defined how we think of indexing. Traditional indexes, as noted in Chapter 3, are cap-weighted. That is, the weight of each stock or bond in the index portfolio is determined by its market capitalization. For the total U.S. stock market, that value is $15 trillion, representing the collective investment of all stockholders of U.S. equities. Remember the Gottrocks family, whom you met in Chapter 1? So it follows that, together, all investors as a group earn precisely the market's return. As you now surely realize, if the market rises by 10%, all investors as a group earn 10%, before costs, of course. So the miracle, as it were, of the index fund is simple arithmetic. By minimizing all of those costs of investing, it guarantees that its participants will earn higher net returns than all of the other participants in stock ownership as a group. This is the only approach to equity investing that can guarantee such an outcome. The only way to beat the market portfolio, obviously, is to depart from the market portfolio. And this is what active managers strive to do, individually. But collectively, of course, they can't succeed. For their trading merely shifts ownership from one holder to another. All of that swapping of stock certificates back and forth, however it may work out for a given buyer or seller, enriches only our financial intermediaries. But the money manager, in effect, puts forth this argument. I'm smarter than the others in the market. I can discover undervalued stocks, and when the market discovers them and they rise in price, I'll sell them. Then I'll discover other undervalued stocks and repeat the process all over again. I know that the stock market is highly efficient, but through my intelligence, my expert analysts, my computer programs, and my trading strategies, I can spot temporary inefficiencies and capture them over and over again. As we have seen in Chapter 8, some fund managers have actually succeeded in this task, but they are precious few in number. Over the past 36 years, just 3 funds out of 355, 0.8%, have consistently distinguished themselves. Nonetheless, hope springs eternal among money managers, and they strive for excellence. Of course, they believe in themselves. This field has few shrinking violets. But they also have a vested financial interest in persuading investors that if they have done well in the past, they will continue to do so. And if they haven't done well in the past, well, better days are always ahead. But in recent years, something new has been added to the mix. Financial entrepreneurs who believe, I'm sure sincerely, if with a heavy dollop of self-interest, that they can create indexes that will beat the market. Interesting. They have developed new methods of weighting portfolio holdings that they vow will outperform the traditional market cap-weighted portfolio that represents the holdings of investors as a group. This new breed of indexers, not in fact indexers but active strategists, focuses on weighting portfolios by so-called fundamental factors. Rather than weighting by market cap, they use a combination of factors such as corporate revenues, cash flows, profits, or dividends. For example, the portfolio is weighted by the dollar amount of dividends distributed by each corporation, rather than the dollar amount of its market capitalization. They argue, fairly enough, that in a cap-weighted portfolio, half of the stocks are overvalued to a greater or lesser extent, and half are undervalued. The traditional indexer responds, of course, but who really knows which half is which? The new fundamental indexers unabashedly answer, we do. They claim to know which is which. And, this will not surprise you, the fundamental factors they have identified as the basis for their portfolio selections actually have outpaced the traditional indexes in the past. We call this data mining, for you can be sure that no one would have the temerity to promote a new strategy that has lagged the traditional index fund in the past. The members of this new breed are not shy about their prescience. They claim variously, if a tad grandiosely, that they represent a new wave in indexing, a revolution that will offer investors better returns and lower volatility, and a new paradigm. Indeed, they describe themselves as the new Copernicans, after the man who concluded that the center of the solar system was not the Earth, but the Sun. They compare the traditional market cap-weighted indexers with ancient astronomers who attempted to perpetuate the Ptolemaic view of the Earth-centered universe. And they assure the world that we're at the brink of a huge paradigm shift in indexing. Of course, they come armed with vast statistical studies that prove how well their methodologies have worked in the past, or at least since 1962, when their back-tested studies began. But think for a moment about the message of Chapter 8. In mutual fund investing, the past is not prologue. These new paradigmists casually ignore that truism. For example, dividend indexes outperform capitalized weighted indexes, not have outperformed in the past. The fundamental index adds more than twice as much incremental return, not has added in the past. Investors, and managers too, love to believe that the past is prologue. It would make life so easy. But it is no accident that these new index funds are being introduced only after their strategies have seen their best days. Since the stock market bubble burst in 2000, for example, value stocks outpace growth stocks. The market cap index holds both over the subsequent 5 years. And for dividend-paying stocks, the pattern is about the same. Even including this recent advantage, the long-term margins of superiority achieved by these theoretically constructed back-tested portfolios are not large, between 1% and 2% per year. How much of that edge would have been confiscated by their expense ratios? The lowest is 0.28%. The average is about 0.5%. The highest that I've seen is 1.89%. How much would have been confiscated by their extra portfolio turnover costs compared to the classic index funds? How much would have been confiscated by extra taxes paid by shareholders when that turnover results in gains? Even if the modest margins claimed in the past were to repeat, which I believe is highly unlikely, these back-tested hypothetical returns would be significantly eroded, if not totally erased, by those costs. But the central issue is how can one claim that the past will be prologue and do so without a scintilla of apparent doubt? The new paradigmists have never explained why these fundamental factors have been systematically underpriced by the market in the past. And if they are underpriced, why investors, hungry to capitalize on that apparent past inefficiency, won't bid up prices until the undervaluation no longer remains. Put another way, if these promoters of the purported new paradigms actually have been right in the past, won't they therefore be wrong in the future? When managers of active equity funds claim to have a way of uncovering extra value in our highly but not perfectly efficient U.S. stock market, investors will look at their past record, consider the manager's strategies, and invest or not. These new index managers are in fact active managers. But they not only claim prescience, but a prescience that gives them confidence that most sectors of the market, such as dividend-paying stocks, will remain undervalued for as far ahead as the eye can see. I recommend skepticism, for I have always been impressed by the inexorable tendency for reversion to the mean in security returns. For example, mutual funds with a value mandate have generally outperformed those with a growth mandate since the late 1960s. But since 1977, indeed since 1937, there is little to choose between the two. In fact, from 1937 through 1967, growth mutual funds rather consistently trumped value mutual funds. Never think you know more than the market. Nobody does. We never know when that reversion to the mean will come to the various sectors of the stock market. But we do know that such changes in style have invariably occurred in the past. With so much of the stock market's volatility based on expectations, emotions, rather than business, economics, what else could be expected? Before we too easily accept that fundamental indexing, relying on style tilts toward dividends, value, or smallness, is the new paradigm, we need a longer sense of history, as well as an appreciation that capitalization-weighted indexing does not depend on efficient markets for its utility. We have witnessed many new paradigms over the years. None has persisted. The concept stocks of the go-go years in the 1960s came and went. So did the Nifty 50 era that soon followed. The January effect of small-cap superiority came and went. Option income funds and government plus funds came and went. In the late 1990s, high-tech stocks and new economy funds came as well. Today, the asset values of the survivors remain far below their peaks. Intelligent investors should approach with extreme caution a claim that any new paradigm is here to stay. That's not the way financial markets work. We do know that traditional all-market cap-weighted index funds guarantee that you will receive your fair share of stock market returns and virtually assure that you will outperform, over the long term, 90% or more of the other investors in the marketplace. Maybe this new paradigm of fundamental indexing, unlike all the other new paradigms I've seen, will work. But maybe it won't, too. I urge investors not to be tempted by the siren song of paradigms that promise the accumulation of wealth that will be far beyond the rewards of the classic index fund. Don't forget the prophetic warning of Karl von Clausewitz, military theorist and Prussian general of the early 19th century. The greatest enemy of a good plan is the dream of a perfect plan. Put your dreaming away and stick to the good plan represented by the classic index fund. Don't take my word for it. I feel strongly on this point, and I'm not alone. First, hear these words from Gregory Mankiw, Harvard professor and former chairman of the President's Council of Economic Advisers. I am placing my bets with Bogle on this one. Then listen to William Sharpe, professor of finance at Stanford and Nobel laureate in economics. It is quite remarkable that people think that somehow a scheme that weights stocks differently than capitalization can dominate a capitalization-weighted index. New paradigms come and go. Betting against the market and spending a considerable amount of money to do so is indeed likely to be a hazardous undertaking. Consider, too, this caution from John R. Minahan, Director of Research at New England Pension Consultants. I am amazed by all the managers that make an assertion of the type, in the long run, X always wins, where X could be dividend yield, earnings growth, quality of management, a quantitative factor or mix of factors, etc., yet are unable to cite a reason why X should systematically be underpriced by the market. The managers may be able to point to data suggesting that X has been associated with excess returns in the past, but without a plausible explanation of why X should outperform. Such data do not convince me that X is likely to outperform in the future. Finally, consider this affirmation of classic indexing from Wharton School professor Jeremy I. Siegel, author of Stocks for the Long Term and advisor to Wisdom Tree Investments, the promoter of the dividend-driven fundamental model. It can be shown that maximum diversification is achieved by holding each stock in proportion to its value to the entire market. Hindsight plays tricks on our minds, often distorts the past, and encourages us to play hunches and outguess other investors, who in turn are playing the same game. For most of us, trying to beat the market leads to disastrous results. Our actions lead to much lower returns than can be achieved just by staying in the market. Matching the market year after year with index funds such as the Vanguard 500 portfolio and Vanguard's Total Stock Market Index Fund. This quotation is from the first edition of Dr. Siegel's 1994 book. I understand that he has every right to change his mind. Chapter 15. The Exchange-Traded Fund, a traitor to the cause. Even before the rise of the so-called new paradigm of fundamental indexing described in the previous chapter, traditional indexing was being challenged by a sort of wolf in sheep's clothing, the exchange-traded fund. Simply put, the ETF is a fund designed to facilitate trading in its shares, dressed in the guise of the traditional index fund. If long-term investing was the original paradigm for the classic index fund designed 31 years ago, surely using index funds as trading vehicles can only be described as short-term speculation. If the broadest possible diversification was the original paradigm, surely holding discrete, even widely diversified sectors of the market offers less diversification and commensurately more risk. If the original paradigm was minimal cost, it's clear that holding market sector index funds that are themselves low cost obviates neither the brokerage commissions entailed in trading them nor the tax burdens incurred if one has the good fortune to do so successfully. As to the final quintessential aspect of the original paradigm, assuring, indeed guaranteeing, that you will earn your fair share of the stock market's return, the fact is that an investor who trades ETFs has nothing even resembling such a guarantee. In fact, after all the selection challenges, the timing risks, the extra costs, and the added taxes, the typical ETF investor has absolutely no idea of what relationship his or her investment return will have to the return earned by the stock market itself. Let me illustrate the differences between the classic index fund and the index fund nouveau represented by the ETF. The ETFs march to a different tune than the original, and I'm left to wonder, in the words of the old song, "What have they done to my song, Ma?" The first exchange-traded fund, created in 1992 by Nathan Most, was named Standard & Poor's Depositary Receipts, SPDRs, and quickly dubbed SPIDER. It was a brilliant idea. Investing in the S&P 500 index, operated at low cost with high tax efficiency, and held for the long term, it held the prospect of providing ferocious competition to the traditional S&P 500 index fund, although brokerage commissions obviated its use, for example, by investors making small, regular investments. Most of the investors in the SPIDERs, however, were not long-term investors. They were active money managers, hedgers, and professional traders. Some 65 million shares of SPIDERs, $8.8 billion worth, are now traded every day, with an annualized turnover of some 3,600% per year. From that single fund, ETFs have grown to be a huge part, $340 billion, of the $900 billion index fund asset base, a 38% share, up from just 9% as 2000 began and only 3% a decade ago. Led by index portfolios whose shares are rapidly traded in narrow market segments, and despite their stark contradiction of each of the 5 concepts underlying the original index fund, ETFs have become a force to be reckoned with in the financial markets. Their amazing growth certainly says something about the energy of Wall Street's financial entrepreneurs, the focus of money managers on gathering assets, the marketing power of brokerage firms, and the willingness, nay, eagerness, of investors to favor complexity over simplicity, continuing to believe, against all odds, that they can beat the market. When we look beyond the dollar aggregates, it becomes clear how far ETFs have departed from the norm. The diversity of the investment choices available is remarkable. Among the 285 ETFs available today are 12 total stock market index funds, such as the SPIDER, the largest segment in terms of assets, 66 focused on investment styles, 133 based on stock market sectors, and 56 concentrating their assets in particular foreign countries. Footnote: amazingly, there are an additional 150 ETFs in registration at the Securities Exchange Commission. Could this be a fad? There are also a handful of bond ETFs and a scattering of ETFs utilizing high leverage, doubling the swings in the stock market, tracking commodity prices and currencies, and other high-risk strategies. In recent years, the flood of assets into ETFs has approached a stampede. Since 1999, ETFs have drawn $280 billion of net new money, even larger than the $190 billion flowing into their classic cousins. What's more, the flow into style, sector, and foreign funds has overwhelmed the flow into the broad stock market index component. While in the early ETF years, these broad funds accounted for 100% of the total ETF inflow, during 2000 to 2006, they accounted for less than 20%. So far this year, their $2 billion of cash outflow presents a startling contrast to the inflow of $40 billion of cash that's been poured into the less diversified groups. All stock market ETFs are, in my view, the only instance in which an ETF can replicate, and possibly even improve upon, the 5 paradigms of the original